You're sitting in seat 32B, middle row. Economy. You paid $340 for this ticket 3 weeks ago. The person next to you paid $89. The person in front of you paid $670. And the airline selling all 3 of you this exact same flight? They're hoping none of you realize they'd be perfectly happy if ticket sales disappeared tomorrow. Not broke. Not struggling. Actually thriving. Because the entire airline industry has been quietly running a business model that has almost nothing to do with flying you anywhere. Let me show you what I mean. In 2019, American Airlines made $45.8 billion in revenue. Sounds like a lot. But here's the weird part. Their operating profit from actually flying people around was about $1.5 billion. Not great. Not terrible. But here's what no one talks about. That same year, their co-branded credit card program with Citi and Barclays generated nearly $4 billion in direct payments to the airline. $4 billion. From credit cards. Delta, same story. In 2020, Delta took out a $6.5 billion loan using their frequent flyer program as collateral. Not their planes. Not their gates. Not their brand. Their miles. And the banks agreed. Because those miles are worth more as a financial asset than the metal in the sky. United, Southwest, every major carrier now runs the same play. The planes are the side hustle. The real business is selling you points you'll never use and charging other companies to let you earn them. This isn't speculation. This is their SEC filings. And once you see it, you can't unsee it. So, how did we get here? Let's go back. The year is 1981. The Airline Deregulation Act has just ripped apart the old system where the government controlled who could fly where and what they could charge. Suddenly, every airline in America is competing on price for the first time in history. And the math gets brutal fast. Because flying people is insanely expensive and the margins are razor thin. A single Boeing 737 costs about $100 million. Fuel is the second biggest expense, and it swings wildly. Labor is the third. Then there's maintenance, insurance, airport fees, leases, and interest on all that debt they took on to buy the planes in the first place. On average, legacy carriers operate on profit margins between 2% and 5%. Sometimes less. Sometimes negative. Compare that to Apple at 25%. Google at 30%. Even Walmart does better at 7%. Airlines are one of the worst businesses in modern capitalism if you're just talking about moving humans through the air. So in 1981, American Airlines tries something new. They invent the frequent flyer program. AAdvantage. The idea is simple. Fly with us more. Get free flights later. Lock in loyalty. It works. Every other airline copies it within months. But then something unexpected happens. By the mid-1990s, third-party companies start approaching airlines with a pitch. We'll buy your miles in bulk. Millions of them. We'll give them to our customers as rewards. You get cash up front. We get a retention tool. Deal? The airlines say yes. Credit card companies say yes. Hotels say yes. Car rentals say yes. Suddenly miles aren't just a loyalty gimmick. They're a currency. A product. A revenue line. And here's the kicker. When a bank buys 1 million miles from Delta for 2 cents each, that's $20,000 in cash. Immediate. Recognized as revenue right now. But Delta doesn't actually have to deliver that flight until someone redeems the miles. Which might be years from now. Or never. It's prepaid income with no expiration date. It's a loan that doesn't get paid back. It's financial magic. Let's talk numbers. Real ones. In 2023, Delta's American Express partnership alone brought in approximately $7 billion. That's not people buying tickets. That's Amex paying Delta every time someone swipes a Delta SkyMiles card at a coffee shop in Minnesota. Every grocery run. Every gas station fill-up. Delta gets a cut. And they give the cardholder miles in return. Miles that cost Delta almost nothing to create. How much does a mile actually cost the airline to produce? Estimates vary, but it's somewhere between half a cent and 1 cent. Let's call it 0.8 cents. But they sell those miles to credit card companies for 2 cents. Sometimes more. That's a 150% markup on a product that's infinite. They can print miles forever. No factory. No raw materials. Just a database entry. Now zoom out. There are trillions of unredeemed miles sitting in accounts right now. Most will never be redeemed. People forget. Accounts go dormant. Miles expire. Programs change. Life happens. The airlines call this breakage. And breakage is profit. Pure profit. If you never use the miles, the airline keeps the cash and never has to give you the flight. But even if you do redeem them, the math still works in their favor.
Here's why.
When you book a reward flight, the airline isn't losing a seat that would have been sold. They're giving you a seat they couldn't sell anyway. The load factor, the percentage of seats filled on average, hovers around 85% in the US. That last 15%? That's where reward seats live. Seats that would have flown empty. So the incremental cost to the airline of putting you in that seat is almost nothing. A little extra fuel weight. Maybe a soda. But they already got paid 2 cents per mile years ago when Amex bought the miles in bulk. Now they're just delivering on a promise that costs them nearly zero. It's the most elegant arbitrage in consumer finance. But let's get darker for a second. Because this whole model has a side effect no one talks about. The airlines now have a massive incentive to make sure their frequent flyer programs are more valuable than their actual flying business. Think about what that means. If you're Delta and you're making twice as much from your credit card deal than from selling tickets, where do you invest? Where do you focus? What do you optimize for? You optimize for credit card signups. You optimize for spending on the card. You make the miles feel valuable, so people keep swiping. But you don't necessarily optimize for a good flying experience, because the flying experience doesn't drive the revenue anymore. This is why airlines can pack seats tighter, cut legroom, charge for bags, charge for seat selection, charge for early boarding, charge for water on some carriers, and people still keep coming back. Because they're chasing the miles. The worse the base experience gets, the more valuable the upgrade becomes. And upgrades cost miles. Or they cost cash. Either way, the airline wins. It's not cruelty. It's not incompetence. It's rational economic behavior once you understand what business they're actually in. Now here's where it gets really strange. During the pandemic, airlines were grounded. Planes sat empty. Revenue from ticket sales collapsed. The industry was on the verge of total collapse. The U.S. government stepped in with $54 billion in aid. Loans, grants, payroll support. It kept the airlines alive. But here's what didn't collapse. The credit card deals. People kept using their airline credit cards. They kept earning miles, even though they couldn't fly. And the banks kept paying the airlines for those miles. Delta, American, United, they all kept collecting billions from their credit card partnerships while their planes sat on the tarmac. In fact, some airlines used their frequent flyer programs as collateral to borrow more money during the crisis. Delta borrowed $6.5 billion against SkyMiles. American borrowed $10 billion against AAdvantage. The banks were happy to lend because they understood the value. The miles were the asset. The planes were just the marketing. Think about that for a second. The thing we think of as the airline, the flying part, was the thing that almost killed them. The thing that saved them was a points program tied to credit cards. So where does this go? Right now the model is sustainable because people still want to fly. The miles are redeemable for something real. A seat on a plane. A trip. A vacation. That's what gives the miles their value. But what happens if airlines decide, consciously or not, that flights are a loss leader for the real business? You're already seeing the edges of this. Reward seats are harder to find. Blackout dates are more common. The number of miles required for a ticket keeps going up. Delta famously moved to dynamic pricing for award travel, meaning there's no fixed chart anymore. The miles required can change by the day, by the hour, based on demand. This is the airline saying, we'll honor the miles, but only when it's convenient for us. And people accept it because they're invested. Emotionally. Financially. They've spent years earning those miles. They've built their travel plans around them. They've paid annual fees on credit cards to keep earning them. It's sunk cost fallacy at industrial scale. Here's the uncomfortable question. If airlines make more money selling miles than selling tickets, how long before they start treating ticket buyers like the problem? You're already seeing hints. Basic economy fares that don't earn miles. Fares so restricted you can't even pick a seat. The message is clear. If you're not feeding the loyalty program, you're not the customer we want. This isn't theoretical. In earnings calls, airline CEOs talk about premium revenue and loyalty program engagement far more than they talk about filling planes. The language has shifted. The priority has shifted. And here's the really wild part. It's working. The stock market loves it. Investors love it. Because loyalty programs are predictable, high margin, recurring revenue. Ticket sales are volatile, low margin, and subject to fuel prices, terrorism, pandemics, recessions, all the chaos of the real world. Miles don't care about oil prices. Miles don't get grounded by weather. Miles are pure financial engineering. So the next time you're crammed into a middle seat, paying extra for carry-on, watching someone in first class get a warm towel, remember this. That ticket you bought? It might have barely kept the lights on. But the credit card in your wallet with the little airplane logo on it? That's the reason they're still flying at all. The airline doesn't need you to fly. They need you to swipe. And once you see the incentives, everything else makes sense.